Okay, great. So here I am with Wendy Craft. And Wendy, could you just tell me first your title and role?
Sure. I'm CEO of the Elle Family Office, and that means I had a single family office.
Okay, fantastic. So on a day-to-day operations level, like what would you say is a typical day look like for you?
There is no typical day in family office. There just isn't. I mean, certain days we are working on the trust and estates. Other days we're working on legacy issues. We may be working on governance or a mission statement. The family may have an emergency or be traveling. You just have to be able to have your list of things that need to be done and also put that list aside and do what needs to be done before you go back to what you should be doing. You have to be nimble.
Okay, so as the sort of overseer, you're in the kind of a weird way a project manager, which is the ongoing family office's project.
Yep.
Okay. And you and I connected initially because I had sent you an article that I wrote on chronic anxiety being the real threat to family office wealth and generational transfer. And
Mhm.
you, in your response to me, partially agreed that that was definitely a threat. First, I'd love to hear what you have seen. Why is that a threat? How? And just what has your experience been like?
Well, I think that more so now that we have social media, definitely. Families are worried about not getting it right. And it's almost like a catatonic frenzy. You see there, I don't know what to do. Is AI really a bubble? Is it not a bubble? What am I going to do? Or how do I protect my kids? You used to protect your kids by keeping them in your house. Now everybody can come to your house. And so on this generation, you're trying to think, how do I protect my kids and my grandkids who may not be born yet from tech and AI and intrusions and threats that may not be there? Or, it was easier in the old days. Here's a little in oil and gas, here's a little in real estate. So on the investment side, you don't know what's coming. I will tell you 25 years ago when I started, there was no tech bucket. There was no tech. You couldn't invest into it. 15 years ago, other than maybe drones, you couldn't invest in space. Right. So times change. And in the family office, we're really trying to use a crystal ball that we do not have to see what is coming. How can we preserve our values, our legacy, our money for further generations against threats that we can't even imagine? And that leads to a lot of anxiety on our part. And sometimes that anxiety can be so extreme, and you almost feel immobilized, like, I don't know what to do next. This is the way we always did it. We can't do it that way anymore. What do I do?
So would you say that that's the sort of emerging realization that the world is changing fast, and there are so many options that people just get sort of analysis paralysis?
Yeah, yeah, catatonic frenzy. You really just don't know which way to turn. And so many of the investment scenarios that are presented to us are so temporary. Used to be somebody built a company and they were going to hold that company for 60 years. So if you invested in it, this is something you're leaving your kids. They don't do that anymore. People are coming up with fintech and AI to sell it to Google or Palantir or any of them. So it's a different look at investing in something that might be sold to somebody else in 5 years than it was investing in something for 50 years. Pick timber if you want to, that you could leave to your kids. So, what is going to be the next investment that I can't even imagine that's going to be there so that I can make sure that things are put in a way that it's going to leave enough value for the next generation?
And is that because our families moving away from more traditional sort of what you might call proven asset classes? And do they feel that the old standard asset classes are less proven, so they need to sort of keep up with trends?
Well, but what are the standard asset classes? That's really the problem, right? Real estate used to be real estate. And then the next thing we knew, they put in new windows and it was sustainable real estate. And now they're adding AI into the stack. And so it becomes tech real estate. And maybe a data center will go in. So your real estate's really infrastructure. And what is real estate anymore?
So, okay, you challenge the premise of the question because real estate is not just a building
Not
anymore.
anymore.
It's morphed with AI, and you're making a case that it's sustainability. So, it seems to me that I don't know if we've seen that in history in the past, sort of morphing,
We
but we're,
We haven't. Think of it this way. You have a 30 unit apartment building and your buddy has one right next door. Could his be better than yours? Yeah, his could be a luxury. But if you still have this 30 unit apartment building and now he has a pad on the roof that can take drone deliveries going to a shoot and then you can get an automatic AI message on your phone, hi, your delivery is here, or so and so is at the door and you gave us AI is going to run these buildings. So the buildings that have it with the capability to support it are going to be a very different asset than 30 homes that you have to tell the doorman your friend is coming over. It's just so different. And where before those differences were a little bit like you had nicer windows, you had nicer flooring, it is now the tech that has kind of come into the space that
mm-hmm.
is going to be a huge differentiator.
Yeah, okay. So families are not allowed anymore. That's not quite the right word, but the system is changing such that they they can't think in terms of traditional asset classes because they're literally vanishing or they're morphing into something different.
They are, right? Even oil and gas. AI is going to find that oil and gas. So
Yep.
instead of guessing which well might give you the biggest return, AI is going to tell you which well. And then it's a matter of who has the right connections to get into that deal.
Hmm. So it definitely requires a forward-mindedness and a nimbleness.
Yeah.
Okay. Okay. So my original thesis is that Bitcoin as an asset class reveals that chronic anxiety the most efficiently because Bitcoin has no committee meetings. You can't change Bitcoin. You can't ask its permission. It just keeps going, doing its thing, regardless of if anybody believes it or doesn't. It just keeps confirming blocks every 10 minutes. But you're making an argument, and I can see how a changing asset class such as real estate would also either create or reveal a sort of ongoing chronic anxiety.
It would. And now we see, you think of Bitcoin as its own asset class. I don't. Because now real estate, there's a few, and you know who they are. They're trying to tokenize, maybe not Bitcoin, but tokenize real estate.
Yep.
So much like tech, that is starting to bleed over into the other buckets.
Yeah.
And you still have, and it's not a fair playing field because you still have countries and sometimes even states. I was from New York, so I knew the ATMs were right outside the border for Bitcoin in New Jersey. So it wasn't an even playing field. Then you have generational differences where the older people, in most part, who control the money are not sold on the idea. The younger people who are sold on it and like it, and you've got to come together. I don't know when that will be. I don't know how it will be. And then
Mm.
we we have a few people in the family office space running around saying, I wouldn't buy Bitcoin. Quantum computers are coming. It's going to bust Bitcoin.
Yep.
So everything that might look good, there's people saying it's going to blow up. Yeah, that causes some anxiety.
Yeah, absolutely. There's 1,000 different opinions, and we're just very early in the space, but we're also early in the AI space. It's just the front end of a lot of changes that I can see coming.
Every couple of years instead of every 10 years. And that
Yeah,
makes planning when a family office has, a 100-year highway they're looking down and things are going quarter of a mile. It's really tough.
it's tough. So, to what degree have you seen downside risk mitigation or hedging options or anything that sort of mitigates the downside used in the family office space?
It's starting to. So I was just at a conference and one of the classroom breakouts was on that subject. How can we do it this way so that we don't have to worry about all the swings? I mean, let's be honest, the market's been it's been up, but it's been a bit of a roller coaster. There's been a lot of volatility. Um, I would even argue volatility in traditional assets. Oh, it's distressed. No, it's not. It's a great opportunity. And you don't know where to turn. And it almost seems that wherever you turn, you're going to get that different opinion.
Mhm.
So I've seen more people with hedge funds put on tail risk insurance than I would say I've probably seen in a long time. Yeah, I'll
Mhm.
invest in it. And my point is, well, but doesn't that insurance cost almost all your profit? I sleep at night, Wendy. Okay,
Mm.
alrighty then. If that's what it takes. Um, I have seen more people moving to public markets. Probably in the last, let's say, 6 to 8 months, there's been a lot of chatter around that. I think we're going to stay out of private equity, go to the public markets. They're not returning our money. And that's just not true of every fund. But things in our space do get painted with a broad brush when somebody has a bad experience. And it's not
Mhm.
unfair to say there have been some private equity funds that have stretched out their lockup to almost 10 years and they're not returning the capital. It's given rise to I mean, they had secondaries 20 years ago, but that was always like SpaceX stock, and now it's GP stakes. So it's gotten very different.
Okay. And when you say public equities, are you talking about like S&P 500, like an SPY, or something different?
No, definitely the S&P. I think they're one benchmarking a lot of it.
Okay.
Um, Compounding, returns back in and just handling it that way. Obviously, we're always concerned about, the taxes on things if we have stuff coming out. I've seen a lot more families look to private funds that have distributions because they're no, and part of that's that trust issue. Well, if there's a chance I won't get my money back, I want to make sure I'm getting some every every quarter, so at least I'll feel like I haven't lost it all. So on investments that typically wouldn't have had distributions, people are still saying, oh, well, what would be the chance of the distributions? And I feel sorry for the people on the private side, the managers, because they keep trying to switch the models to accommodate. But even your endowments and your pensions are now having that thought because some of their grant funding has been cut off. They have scholarships that come out. They've got to have some liquidity too, whereas before it wasn't that big of a deal.
Mm.
Um, and so now they're asking the same question. So I would suspect within the next 2 years, if not sooner, that you're going to see a lot more private investments having distributions.
Mm. Boy, so many questions from this conversation. How you doing on time?
I'm good.
Okay. Well, then let me ask my next question then. So it seems to me that if the 10-year lockup, just as a, we're going to choose that as our whipping boy, is starting to go away because people are demanding liquidity, I would imagine that has to affect the quality of investments, or at least the way the manager is selecting how they're thinking about investments. Is that going to affect returns or volatility? Like, what are you seeing?
I don't know. It's just now happening. I was talking to a bunch of families last week, and they're going to lower their allocations to private equity.
Okay.
And as that pushback comes on, the managers are going to adjust. I would suspect, and I do not have a crystal ball, that instead of having a pure credit fund, pure debt fund, or some type of illiquid thing, they're going to mix it. So if you remember, and I'm going to take you back about 12 years when fractional shares of sports teams started, and people are like, well, you can't expect money out of this. You're not getting a piece of the Coca-Colas and hot dogs. This is a passion investment. You get to say you're the proud owner of. And people were like, yeah, I don't like it. And all of a sudden they started mixing it. So there's a couple of houses out there I know very well. You get the fractional share, but it's tied into some other things. So it's generating returns. So now it's a mix. They did it really badly 10 years ago, like here's a token with a player or something, you'll make a lot of money. But now usually it has like the fractional shares of sports may have a tech thing in there, something that's going to kick off distribution money. I'm going to guess that private equity type managers, and we can just ball in credit and debt, because that's what I think is going to happen. I think they're going to pull in some other pieces and create a fund that will have some characteristics of a public investment, but still be private and have some better returns because it's private and can lock up for 7 years. We'll see. Could be right, could be wrong, but I think we're going to see hybrid investments.
Okay, so it'll be just like the market economy at any time in history. The strong will survive, the weak will fall off, and time marches on.
Just like in AI.
Yeah, exactly. That's something that I love about the free market is that it rewards merit. In the pockets where it does reward merit, it's fantastic. Yeah.
Agreed.
So for my final question, I want to sort of gather up our whole interview and make a statement about the info that I've gleaned from you, apply it to the way that I'm thinking, and then just get your comment. And you'll know what I mean when I do this. Okay. Edwin Friedman studied and came out with the idea. Well, what he did was he applied Murray Bowen's theory to basically churches, but think of a church as a business. So Murray Bowen talked about,
some are.
Church is a business. Everything is a business. So Bowen talked about anxiety, chronic anxiety as it runs through family systems, and that being the number one thing that either makes or breaks a family, and specifically the leader's ability to maintain their sense of self under pressure for consensus, pressure to not make a decision that would upset the apple cart, that sort of thing. So what I'm seeing going on now in this, based on this interview, in this crazy changing environment with AI and sustainability, for example, morphing into real estate, everything pivoting, lockups going away, that sort of thing. That analysis paralysis, given that would up a leader's anxiety, it seems to me that now more than ever, a leader must know how to stand in themselves, not be swayed by voices that would pull them down into an anxiety loop, but at the same time continue to listen to strong voices, receive counsel, but then ultimately just make a decision even when they don't have complete information, and it might be uncomfortable. So that was a long statement, but I'd love to hear your thoughts on that.
The best thing about family offices is, and I know this is very hard for sell side, we don't have to invest. Now, that's a little facetious. We do have to invest, but we don't have to invest tomorrow, right? We all have vast portfolios. Maybe it's doing 7, 8%, which we would like it to be higher, but we don't have to take money, dry powder on the sidelines, and put it into a data center or we're hosed, right? That doesn't happen. So you have to be calm in turbulent times. And by that, I'll give you an example. Data centers. They're not making money. They're just not. The people that are creating the data centers think it's the thing to do. And I will tell you, went to an Invesco conference and they're shrinking. In 2 years, they'll be a tenth of the size. Maybe they'll be going into commercial buildings. So is that something I'm going to feel anxiety about? I didn't invest in a data center. No, I'm going to wait. And in 2 years, there may be something where I think it's going to make money because it'll be in a commercial building coupled with a lease. Or the mini nuclear will take off, which is what a lot of us think will happen. And that can put energy back in the grid and it can create returns. But I feel zero anxiety about investing in that particular asset at the moment. And could I be wrong? Maybe. And I'll live with it if I am. But I think in 2 to 3 years, something better is coming. Much like I don't feel any pressure to invest in a current private equity scenario because I think the pushback, and I talk to people all the time, and you've got to do that. with all the pushback coming, I think they're going to come up with a better model. And I think it'll might have a little less return, but I think there's going to be cash distributions coming out on a regular basis, which helps families. Um, so you just have to take a deep breath, understand that everything is always going to change, and kind of see through it and see down the road a little farther, look through what's happening to what might happen down the road and try to judge for that and not jump. Like, I will pick on SpaceX. Everybody was like, oh, did you get your pre-IPO SpaceX? Oh my gosh. Well, you and I both know that 180 days out, especially since a lot of them are locked up for 6 months, there might be a dip. Maybe I would have gotten a better deal at pre-IPO prices, but I'm gonna bet I might get a pretty good price at that 180-day dip. And I'm willing to do that. And will I be very anxious if that doesn't work out the way I think? Sure. But we thought about it, we talked about it. Uh, it was very thoughtful. And let's see what happens. You don't win on all of them, and it's okay too. But if Elon's able to go to Mars, that stock might really go up, right? But how do you get the return? What's the stock? What's behind the stock value that would make it go up? And I think you have to do that with everything. I think you just got to take a deep breath and say, yeah, you might miss this one or that one, but look, you got these ones. And stability and longevity is always going to win over, the quick and the newfangled for families. Different for high net worth investors, but for families, it's a long road to go. We're looking 100 years out. So,
Yeah. So that's a very low anxiety, what I think Bowen or Friedman might call a highly differentiated position that you're taking. Yeah.
I would say most of my friends in family office are very much the same. They're much more worried about what all of this is going to do to their kids than missing the
So
latest and greatest investment.
yeah, yeah, absolutely. Because we're not in it, you're not in it to double your money, you're in it to not cut your money in half.
Exactly. Well said. That's
Mm-hmm.
that's the slogan right there. Yeah,
Mm-hmm.
and that's what we are.
Okay. Great. Well, thank you, Wendy. This has been fantastic. I appreciate your time and your thoughtful conversation. And yeah, thank you very much. I'd love to do it again.
I would love to. You are a pleasure. Thank you so much.
Thank you. Great.